Alright, what's good my traders? Welcome back to the channel. Thank you for clicking on this video. Today we're going to be going through an absolutely complete comprehensive guide about candlesticks. You can call this the candlestick bible, the candlestick book, whatever you want to call it. We're going to be going through absolutely everything from top to bottom, from the very basic stuff like what is a candlestick and how do you actually read price and wicks and all of that stuff, to much more advanced topics like market sentiment, like the behavior, like reading candlestick gaps and all the other stuff that kind of goes into that. So regardless of your current experience level, I'd really recommend watch the video right up until the end, because the topics are going to get more and more difficult and more advanced the further that you watch this video. So even if you do know a lot of this stuff from the get-go, I promise you watch the video until the end, because you will probably learn something that's going to be very beneficial. Now let's just jump right into the video and get started. Now these right here are your bog standard Japanese candlesticks. Now for me, I've got green and white as my candlestick colors. Green is bullish, so up, and my white is my bearish candles, so down. Now by default on TradingView, your candlesticks are going to be green and red. I would highly recommend changing this to some less emotional colors. Green and red are very psychological colors, and they'll do a lot to your psychology. Now I don't necessarily mean that if you have green and red candlesticks, you're going to be unprofitable. It doesn't work like that, but you're just going to be more susceptible to having psychological lapses with those emotional colors, so you're just better off not having them. Obviously at a certain stage it doesn't matter, and you can trade whatever you want to trade, which is why I've got green currently. But initially, if you're getting started, it's just a little bit of a tip just to make it easier on yourself. So these are your candlesticks. Now, before we can actually get into behavior and sentiment and volume and all of this stuff, we first need to understand what actually is this and how are we reading it. Now let's come down here. Now again, I'm sure a lot of you guys know this because this is very basic trading content. But like I said, as this video progresses, we're going to be getting more and more advanced. I just want to make it very comprehensive. So we have two types of candlesticks. We've got a bullish candle on the left and a bearish candle on the right. Now you can see we have a fat section right here, which is the candlestick body. And then we have two lines going up and down either side. Now let's look at a bullish candle for this example. Now each candle is always going to be based off of a specific time frame or a set period in the market. Now right now I'm on a 1 hour chart, which means each candlestick represents 1 hour in time. So for this example, this is also a 1 hour time frame. So we have the body open, and this is simply where price opens for that hour. And we have the body closure, very simple. This is where price closes for that hour. So we open up here for 5 p.m. and we close up here for 6 p.m. That's 1 hour of time. We've opened, we've closed, and that creates the candlestick body. Now the wicks either side show you where price has been throughout that duration of time, but has been unable to maintain. So at some point throughout that hour, we came the whole way up here, creating the top wick. And we came the whole way down here, creating the bottom wick, but we were unable to maintain, and price ultimately opened here and we closed here. And that's where you get the shape of the candlestick. This is the data that price is giving you. Now a lot of people disregard the wicks. A lot of people are only paying attention to the bodies, but the wicks are super important about reading behavior, about understanding sentiment and where price wants to go, because oftentimes price will wick and it will tell you something during the wick and then have the move a little bit later on. So once we get into the concepts like depletion and stuff later on in the video, you're going to understand what I mean. But price can give you an indication of what it wants to do by simply wicking and telling you something, and then it has the movement. So right here for this hourly candlestick, again, all we can see is a body open and a body closure and two wicks either side. But if we were to zoom in, for example, to a 5-minute time frame, you'd be looking at more price action like this. So you'd be looking at higher highs and higher lows and a unique structure within a single candlestick. And again, this comes into multi-time frame analysis, which is a concept we'll get into in a little bit. But again, you can see right here, you can see where price created the bottom wick and where we created the top wick. But ultimately, we opened a little bit higher and we closed a little bit lower. And that's what created this formation right here. All right, cool. Now, a bearish candlestick is the exact same principle, but you're just flipping everything upside down. So a bearish candlestick will open at the top and it will close at the bottom because price needs to move downwards. And that's where you create a bearish candlestick from. So very easy example. So hopefully everyone's following with me up until this point. So this is essentially what makes up the market. We have bullish candlesticks, we have bearish candlesticks. Price is always opening and closing, and we're always trying to move somewhere. Now the wicks and the bodies are very important in their own unique right, but they do very different things. They serve very different purposes. Now when we're talking about market structure, and when I say market structure, I'm referring to higher highs and higher lows again. If you're watching this video, I would assume you know market structure. If you do not, let me know in the comments and I'll make a video about that. But when we're talking about market structure, higher highs, higher lows, uptrends, downtrends, these need to be bodies. So in order for price to break structure, in order for a level to be broken, in order for something to be tested, in order for basic market structure to be formed, these points of structure need to be the bodies. These cannot be the wicks. If price breaks a structure with a wick, or it breaks a level with a wick, it hasn't broken a level, it's just wicked the level. You see what I'm saying? A lot of people make the mistake, they'll see price wick above an area and they will believe that the wick is the break, but the wick is the rejection of the break. You see what I'm saying? Let me find you an example right here actually. So for example, right here, we've got a nice standard key level just drawn from this upside accumulation. Right here to the right, you can see that price comes just above and it wicks the level. Now, again, if you're an experienced trader, you're probably looking at this like, okay, cool, it's just a wick rejection, but you'd be surprised how many people actually would class this as a break of structure. And once again, you need to pay attention that just because on an hourly time frame, this looks like a one wick rejection, and it's very easy to identify this as a rejection. On a lower time frame, on a 5 minute, on a 15 minute, this is more than likely a body closure above the level. And if you're not paying attention, you can view that as a break of structure, and you could potentially be trying to trade the buys a little bit too early because you're just not paying attention to how price is forming on a higher time frame. So again, these are all factors you do need to consider. And let's get into the first section of this little course that we're doing right here. And that is identifying candlestick momentum, identifying strength and weakness, because each candlestick will have its own unique strength and weakness. Now, this is not necessarily a metric that you can track 100%, but this is the way that I've personally been doing it. So I like to give every candlestick a strength rating of 1 to 100. 100% being this is ridiculously strong, it's like a bullish engulfing candle, no upside wick rejection, no downside wick rejection, price opens and it closes exactly where it wants to move. To me, that is a strong sentiment candle. There's been no rejection, there's been no hesitation, and on a lower time frame, you're looking for an impulsive movement. If you don't know what an impulsive movement is, make sure you watch my other YouTube video. But essentially, it's a movement that has no retracement. It's a very strong sentiment movement. So to me, that would be a 100% candle. And a 0% candle or a 1% candle would be a straight up doji or an indecision. And this is typically when price will create a candlestick or look something like this. So it's a candlestick that has a very, very small body, which means price opened and pretty much closed in the exact same area, but it has a large wick rejection either side. So right here's another great example. Price opened and closed pretty much at the same level, and we have a big rejection either side. The reason that I say this is a weak sentiment candle is because price doesn't really know where it wants to move. It has a lot of indecision. There's not enough buyers, there's not enough sellers. It doesn't really matter how you want to look at it. But the point is that price opened up, it tried to move up, it couldn't move up. It tried to move down, it couldn't move down, and it pretty much closed where it opened. To me, that is this weak sentiment candle. It's an indecision. And again, it's very, very useful information if you use it within the correct context. Now, you could argue that right here is a weaker sentiment candle because it has even less volume than this one because the wick rejections are smaller. But to me, it's the same difference. I'm primarily focused on the bodies when we're talking about weak sentiment. Now, why is any of this important? Why am I even bringing up the strength of a candle? Why are these percentages relevant at all? Well, this links in very heavily to your system. Now, I'm not referring to just price action. In any system that you trade, and again, correct me if I'm wrong in the comments, but in any system that you trade, more than likely, you're trying to catch the volume movements. More than likely, you're trying to catch these sort of moves here on a chart. There's very few traders I know, or actually any traders that I know, that are actively looking to trade this price action. Because realistically, why would you try and trade the corrective? Why would you try and trade the accumulation? It doesn't make sense. You'd be looking to trade the big impulsive movements, these money movements right here, because this is where the money is at. In order for you to make money on whatever account or whatever position you're trading, you want price to do what? You want price to move. Doesn't matter if it moves up or if it moves down. As long as it doesn't move sideways, you can make money. So your main job as a trader, and again, this is if you were to really simplify it, obviously it is to manage risk and emotion and all of this other stuff. But your main job as a trader is to find the impulsive movements just before they happen, so you can try catch a little bit of this sort of movement right here. So the reason that identifying candlestick behavior and identifying strength of a candlestick is so important is because it can be the first steps in initially identifying when price is going to have these movements, when is price going to have the impulsive, when is price going to have the corrective. And if you're able to identify what price is doing and what behavior is leading to that movement before it happens, you're then in a much better position to capitalize off of the movement. And again, it all stems back to the candlestick and the strength of the candle. So let's get into a little bit of basic depletion. Now, I'm pretty sure I do have a complete breakdown of this on YouTube, so I'm going to put the pop-up for it right here if I remember in editing. But let's get into some basic depletion. Now, what is depletion and why is this a useful concept? Now, depletion refers to an accumulation of wick rejections like this. Whenever you see an accumulation of wicks, that's your first indication that there's some sort of depletion taking place. If we were to look at this accumulation of candles, this is like 5 or 6 candles. Now, some of you smart people, some of the people who already know what depletion is, you'll pretty easily be able to spot that right here we have a very, very nice area of depletion. We have 3 bullish candles that are slowly shifting their momentum, slowly shifting their strength, and that then leads into bearish candles that are slowly getting stronger and stronger before the impulsive movement starts. Now, if we really sit here and dissect this, what is actually happening and how could we have identified this beforehand? Because obviously in hindsight, it's very easy to see price done this, and then it's very easy for you to link it in your head because you've seen it. That's hindsight bias. But actually just looking at this price action, what did price do? Well, right here, going based off of my strength indicator or whatever, we have a fairly weak bullish candle right here. I would say this is like a 50% strength candle because it's a bit of an indecision. We leave quite a large wick rejection to the downside, also a wick rejection to the upside, but price still kind of closed a little bit bullish. And you can see that we're also rejecting this low right here. We've essentially left equal lows and price left a bullish candle. We then print another bullish candle immediately after. Now, this next bullish candle is a little bit stronger. The reason I say it's stronger is because we leave a smaller wick rejection to the downside, which means that price didn't try to push down as much as it did on the last candle. And we also close a little bit stronger. We close a little bit higher, a little bit more towards the top of the candle, and we leave a very small upside wick rejection. So we go from 50% strength to, let's say, 60% strength. Now right here, what happens here on this third candle? Well, price actually loses a bit of bullish momentum. We lose a bit of volume. So we go from 60%, let's say, back to 55%. And again, another indecision candle, another accumulation candle. Now what happens right here on this fourth candle? Well, price actually shifts its momentum from being a weak indecision bullish to a weak indecision bearish. Now you see what's happened right there. Price has shifted its momentum, it's changed, it's had a change of character from bullish to weak bearish. Now on the next candle, what does price do? Well, it slowly gets a little bit more bearish. It's getting a little bit more bearish volume. We're leaving a bigger wick rejection to the upside, a smaller wick rejection to the downside, and the body has gotten a little bit bigger. Now this by itself is still not a crazy amount of information, but we can see that right here over the course of 4 or 5 candles, that price has told us that it's losing upside momentum, it's losing that bullish pressure, it's shifting its momentum, and is actively gaining more volume to the downside. Now right here on this 4th or 5th candle, depending on how you're counting it, what happens? Well, we get even more bearish. Price leaves a final wick rejection to the upside, and we have a big bearish candle. I say big, but it's big relative to the previous candles. Now taking it one final step further, and we look at this candle here. Well, again, I'm sure you guys know where this is going, but price leaves a final wick rejection to the upside and has a very, very big downside candle. And you can see this candle right here is actually the candle that breaks all of this structure right here. So this would be your break of structure candle right here. And again, purely just using the candlesticks, just using the momentum that you're identifying, the sentiment you're identifying through the wicks and the bodies, and then combining that with a break of structure, this right here could have been a semi-valid trade depending on how you're trading. And you could have looked to take this a little bit lower, a little bit further to the downside. And again, this is purely based off of just looking at candlestick bodies, looking at wicks, relative, again, everything within context, but looking at the behavior of the bodies and everything relative to the price action you're trading, and using that to identify a good area to trade off of. Now, simultaneously, this works both ways. So if you are in a buy position and you notice this upside depletion, you notice this slow shift in momentum, it would be an indication for you to exit the market or look to take profit or look to manage your risk. But it would be a very, very similar principle. How else can we use candlestick behavior? How else can we use candlesticks to actually help improve our trading? How can we use this behavior, this sentiment reading, to identify when not to trade? Because obviously we've just been through an example of how you can use candlesticks and price and sentiment, all of this stuff, to identify when to execute a position. But how can we flip it and use it to identify when should we not be trading? Because this is a major part of trading as well. A lot of traders don't speak about when not to trade. Everyone's speaking about when to trade, but you forget that a large majority, I would say over 50% of the equation, is actually not trading. And this is another way that you can use to actually start to make your trading a little bit more selective, a little bit more, let's say, higher quality, and stop taking silly positions. So again, this does really heavily link into Elliott wave theory, and it does heavily link into impulsive and corrective waves, which is something I've covered on YouTube previously, so I'd recommend watch that. But this right here is a prime example of when not to trade. You can see that right here. Bear in mind, we're on the hourly time frame. You can see that right here, price is accumulating for a large duration of time. This is at least 15, 16 hours of sideways moving price action. Now, us as traders, we don't want to be trading this. We don't want to be in a trade for 16, 17 hours just moving sideways, because it's not going to benefit us. It's not going to make us any money. And it's just irritating to be in because nothing's happening. There's no need for you to be there. So how do we not trade these moves? How do we not get caught lacking on the sideways moving price? Well, again, coming back to candlestick behavior, the candlesticks will tell you, typically speaking. Now, I don't mean it's not going to print indecision and it's not going to let you know we're about to accumulate for the next couple of hours, but you will gradually see a shift in momentum, and you'll be able to read the previous candles, which will then tell you that, okay, price is losing momentum, it's exhausting, it's printing indecision candles. More than likely, we're going to accumulate this movement, and you can sit there and wait to see the accumulation before you actually take the breakout trade. Now, what does it look like in a chart? We can see that right here. Granted, this is from, okay, this is a bit of a weird market gap right here, so disregard this. This is actually just the Pepperstone provider. This is not actually US 30. A little bit of a different trading gem for you. This is off topic, but if you do come across a chart that seems to have a bunch of gaps to where it shouldn't really have a gap, chances are it's the server provider and not the actual instrument you're trading. So just don't get confused and think, oh, this is a huge inefficiency, and start going into some crazy smart money concepts, because usually it's just the server provider. But back to the point. We can see that right here on Thursday's movement. And again, this links in very heavily to weekly characteristics. All the trading concepts kind of link into each other. So again, let me know if you want a whole video about weekly characteristics. But you can see that right here, Thursday, have a big bullish impulsive movement. We have very strong bullish candles. Again, whenever I start my analysis, I'm always looking at overall price. I'm always looking at the behavior, the momentum. We have a very strong bullish movement right here, very strong bullish candles. Let's say this is 70% strength, 75% strength, 80% strength, 75, 85. This is a bit of an industry pause candle. And then what happens immediately? We leave a big ass wick rejection right here. Now, notice how this is the first rejection candle in about 6 or 7 hours of very strong bullish momentum. So what has price done? Well, it's left quite a large wick rejection to the upside, and it's still sharp bullish. We still had a bullish closure, but this is the weakest bullish closure we've had for a very long while. Now, notice how this candle has come immediately after the first bearish candle, the first indecision candle that price printed in about 10 candles. You then get a depletion candle immediately after. Again, these two candles alone, purely, and again, we're not looking at any other technical factor. Maybe there's a major resistance above. Maybe it's a psychological level. Maybe it's an order block, a pivot point. We're not looking at any of these other factors, but purely based off of the candlestick body, the size of the wick rejection, and the context of the movement, I could tell you that this is a move that's about to deplete itself based off of these two candles. And then lo and behold, what happens? Well, price immediately starts to print these even more indecision candles. We start to print the lower volume candles, and this will typically last for as long as the impulsive movement lasted. Again, linking into Elliott wave theory, you have an impulsive movement, and typically speaking, price will have a corrective movement, or that accumulation period, that will last an equal amount of time in the opposite direction, typically speaking. It's not always the case, not always 100%, but this is just usually how the market forms. So again, after you begin to see this sort of behavior on the back end of a large impulsive movement, that's your indication, number one, to exit the market if you're in a position. And number two, if you're looking to still enter a position, maybe it's a good idea for you to hold off. Maybe as you start to see price losing momentum, as you start to see price depleting on the back end of quite a large movement, that's your first kind of heads up that, okay, cool, we're probably not going to have another impulsive movement immediately. We're more than likely going to have a corrective. So let me wait out, let me sit and wait for the corrective to play out. And then as I begin to see the corrective movement gain a little bit more momentum, and as I see price begin to gain a little bit stronger sentiment, as it does right here, I can then begin to plan out a trade again and look to enter a position. All of this simply comes back down to reading the candlesticks, reading the behavior and the sentiment. Again, I know I've been repeating the same thing for the whole video, but it is super, super important. read the candlesticks. Look at the bodies, look at the wicks, look at the behavior and what that candlestick is telling you. Again, a lot of people look at candlesticks, but they're not really looking at candlesticks. A lot of people will look at this movement. They'll look at this piece of price action right here and they'll be like, okay, cool, price is bullish, it moved up. And that's all they see. They don't look at any external information. They're not looking at the wicks, they're not looking at the bodies, they're not reading the behavior of this movement. Because I promise you, there's a lot of price going on in this sort of price. There's an actual story that is linked into this. And you can actually figure out that story for yourself if you really look, pay attention, and actually try and think of everything in terms of strength, in terms of sentiment, in terms of momentum. And I promise you, this is a major aspect, a factor that really helped me with my technical trading, with my price action, and my strategy, is really learning to read the behavior, really learning to understand, okay, cool, what is price telling me here? What is it trying to do? Instead of just looking at everything like up, down, sideways, this is a candle, this is a candle, look at the behavior, look at the sentiment. But that's it for the video. I'm not going to repeat those words any more times, so let me know if you enjoyed this. If you want a part 2, if you want me to kind of continue to work off these ideas, I will definitely drop that. I do enjoy doing these technical lessons for you guys, so let me know, leave some love in the comments, and I'll make sure to drop some more follow-up videos. But yeah, that's it for the vids. See you.